Imagine opening a bank account advertised as completely free. You start using it daily. Everything seems fine, until slowly your balance chips away. 300 rupees here, 150 there. By the end of the year, you are down 3,000 to 5,000 rupees, and you have absolutely no record of where that money went. Most of us pick a bank because the branch is close to our house, or we saw a flashy ad promising zero fees. We assume the core service costs us nothing. But for the average person, wealth does not disappear in massive market crashes. It drains out through invisible, systemic leaks built to target people who don't read the fine print. The mistake starts with how we view the account itself. We treat a bank as a safe, neutral vault where money just sits waiting for us. In reality, your account is a highly active financial engine, explicitly designed to monetize your passivity and generate institutional profit. To see how this actually works, we need to calculate the true return on investment of a standard bank account by examining 5 specific vectors of wealth extraction. Once you map these out, you will see exactly why choosing a bank purely for upfront convenience guarantees a long-term erosion of your personal wealth. The first extraction vector hides inside the promise of the zero balance account. Banks earn a massive chunk of their revenue, sometimes 20 to 30% in India, strictly from non-interest income. These are the micro fees buried in the terms and conditions: 15 rupees for SMS alerts, 20 rupees per extra ATM withdrawal, 200 for debit card renewal. This simplified ledger shows how those tiny charges stack up, turning into 2,000 rupees extracted over 12 months. You miss it due to small loss blindness. Small deductions don't trigger emotional pain, so your brain ignores them, focusing on the advertised zero fee. By ignoring the fee schedule for the sake of an easy sign-up, you sacrifice the equivalent of a monthly investment straight to the bank in invisible fees. Next is the minimum balance requirement. A 10,000 rupee minimum is standard across many major banks, and most users accept it without a second thought. Banks mandate you keep this liquid cash because they use your idle funds to issue loans and generate their own massive profits. From your perspective, that 10,000 rupees is dead money. It isn't working, it isn't invested, and it is actively prevented from growing. This opportunity cost graph shows that cash over 10 years. In checking, the line stays flat, but invested at a 10% return, it grows past 25,000. That growing gap represents your lost wealth. You keep that money locked up just to avoid a 500 rupee minimum balance penalty, but the actual cost of holding that dead money is upwards of 15,000 rupees in lost potential wealth. The third vector targets the illusion of safety. Most traditional banks offer a savings interest rate hovering between 2.5% to 3%. That sounds like a gain, until you compare it directly to the macroeconomic average inflation rate in India, which consistently runs at 5 to 6%. On a baseline of 1 lakh rupees, your bank pays 3,000 in interest, moving you up. But inflation destroys 6,000 in purchasing power, dragging you below the start. This negative real yield mathematically guarantees your money loses buying power over time. By choosing maximum liquidity and the perceived safety of a basic savings account, you guarantee a silent, compounding loss of your actual purchasing power, slowly eroding your wealth every single year. The fourth vector is digital friction. People heavily underestimate the cost of tolerating a clunky, confusing, or unreliable banking application. A poor user experience creates deep psychological friction. If checking your balance or making a transfer is annoying, you subconsciously avoid logging in. You delay transactions and ignore your money. Behavioral research shows that visibility creates control. Individuals who lack regular, frictionless visibility into their daily finances end up saving up to 20% less annually. You might think you are saving a few hours by avoiding the hassle of switching banks. Instead, you incur a massive behavioral tax that degrades your overall financial discipline. The final extraction vector is systemic risk. Depositors often chase promotional offers or slightly higher yields by consolidating massive cash reserves into a single, lesser-known banking account. Under the DICGC, the Reserve Bank's deposit insurance subsidiary, your money is protected only up to a strict limit of 5 lakh rupees per bank. Any capital spilling over that threshold is entirely unprotected and technically exposed if the institution fails. Catastrophic bank failures are rare, but when a bank is placed under sudden regulatory restriction, the process of recovering uninsured funds is deeply messy and financially paralyzing for the depositors. Gaining a fractional percentage point in yield from a single bank is never worth exposing your life savings to catastrophic uncompensated tail risk. To fix these leaks, you have to stop treating all bank accounts equally. You need to match your banking strategy directly to your actual net worth and financial habits. This decision tree maps out the optimal banking setup. It starts with a simple question. What is your primary goal right now? You either need to stop bleeding fees, or you need to maximize your yield. If you are budget conscious, follow the first path. Ruthlessly hunt down true zero-balance, zero-fee neobanks. You trade physical branch access for the absolute elimination of monthly minimums and micro-deductions. If your goal is to optimize yield, follow the second path. Restrict your primary checking account to hold no more than a 1 to 2 month buffer of living expenses. Every single rupee beyond that buffer must be aggressively routed into higher-yielding instruments. This includes liquid mutual funds or auto-sweep fixed deposits, which are accounts that automatically transfer excess funds into higher-earning deposits to clear the 6% inflation hurdle. And for high net worth liquidity, the rule is absolute. Any cash reserves exceeding 5 lakh rupees must be split across entirely different banking institutions to maintain full DICGC coverage. Smart banking is not a tool for generating immense wealth directly. It is a defense mechanism to permanently plug the systemic leaks that continuously drain your capital. Remaining in the wrong bank account acts as a slow gravitational pull on your money. It creates constant resistance against your forward financial momentum. True financial discipline is rarely built on massive, risky bets. It is built by optimizing your foundational systems once, and then letting the math run smoothly in the background. Before your next paycheck deposits, look at your primary account and run it through these 5 checks. Because mastering money management relies on losing less, thinking better, and forcing the mathematical rules of the financial system to work in your favor.